For months, investors have been asking the same question: how far can NVIDIA actually go before something breaks? Because what we're witnessing right now isn't normal growth. It's acceleration on top of acceleration. A $1 trillion gain in under 12 months. A price-to-sales ratio that hasn't been seen in a mega-cap since the late 1990s. And an expectations curve that only moves in one direction, straight up. But when expectations decouple from reality, history has a very specific way of responding, and that brings us to the comparison no one in Silicon Valley wants to talk about: NVIDIA today versus Cisco in the year 2000. The company that defined the dot-com boom and lost nearly 90% of its value in the correction that followed. Let's start with what sparked this entire conversation. NVIDIA's market cap recently crossed $2.6 trillion, putting it within striking distance of Apple and Microsoft. But here's the part that should make every investor pause. In 1999, Cisco was considered the safest bet in tech, the backbone of the Internet, the company powering every new data center, every network expansion, every infrastructure upgrade. Analysts said its growth was guaranteed for years, and the valuation reflected that. Cisco traded at a price-to-sales ratio above 30. NVIDIA just crossed 38. Cisco ES forward expectations assumed exponential demand for bandwidth and digital infrastructure. NVIDIA's valuations today assume exponential demand for AI compute and data processing. In both cases, the story was the same: unlimited demand, unlimited growth, unlimited runway, until reality proved otherwise. But here's where this comparison becomes more than just a headline. In the 6 quarters leading up to the dot-com peak, Cisco's revenues grew roughly 50%. NVIDIA's data center revenue over the last 6 quarters has grown 458%, not 58%, 458%. When growth curves become that vertical, 2 things typically happen: new competitors appear, and customers begin diversifying. According to supply chain disclosures from December through February, Amazon, Google, and Meta have collectively accelerated the development of in-house AI chips, reducing future dependency on NVIDIA's hardware. This mirrors the exact behavior from the late 1990s when major telecom clients began building their own switching systems to avoid over-reliance on Cisco. Now, why does any of this matter? Because bubbles are not defined by high valuations. They're defined by belief systems. Cisco's belief system was simple: the Internet would grow forever and bandwidth demand would never plateau. NVIDIA's belief system today is nearly identical. AI training will expand indefinitely, data centers will always need more compute, and competitors will remain years behind. But belief systems collapse when a single assumption breaks. For Cisco, it was the bandwidth glut of 2001. For NVIDIA, it may be something far more subtle: a shift from AI model training to AI model optimization. Training requires massive hardware spend. Optimization requires far less. If this transition happens faster than Wall Street expects, the revenue projections backing NVIDIA's current valuation could compress violently. Let me walk you through the 3 indicators I am personally tracking that may signal when the shift begins. The first is hyperscaler CapEx concentration. Right now, roughly 60% of NVIDIA's data center revenue comes from just 4 customers. If even one of those customers slows spending or delays deployments, NVIDIA's growth rate could contract sharply. During the dot-com era, Cisco faced a similar concentration problem. Once telecom providers pulled back, Cisco's revenue dropped almost instantly. The second indicator is accelerator supply inflation. As Broadcom, AMD, Intel, and multiple Chinese suppliers ramp production in 2026, the AI chip market may experience a correction similar to the server glut of the early 2000s. We're already seeing early signals. Taiwan's top component manufacturers reported inventory buildups in Q4. that mirror the pre-collapse patterns seen in other tech cycles. Excess supply always kills margins. In 2001, Cisco's margins dropped from 68% to under 52% in just 4 quarters. If NVIDIA's margins erode even modestly, the stock's valuation multiple cannot hold at current levels. The third indicator is model training saturation. According to internal estimates from multiple AI labs, the cost of training frontier models is approaching diminishing returns. Once companies reach the threshold where improvements per dollar begin flattening, the incentive to purchase massive new GPU clusters declines. This is precisely what broke the telco investment cycle in 2000. The realization that capacity was outpacing utilization. If AI hits that same moment, spending contracts sharply. But here's what's different this time, and it's the reason investors should take this comparison seriously. Cisco lost 86% of its market cap during the correction. If NVIDIA follows even half that trajectory from current levels, we're talking about a $1 trillion to $2 trillion drawdown. Not because NVIDIA is a bad company, Cisco was guessed to either, but because market expectations expanded far beyond what any company can realistically sustain. Let me outline 3 possible scenarios based on historical bubble analogs and current AI spending patterns. Scenario 1, and the most probable at around 45%, is what I call the plateau correction. NVIDIA continues to grow but at a slower pace, and valuation multiples compress. In this scenario, the stock could decline 35% to 45% while revenue normalizes. This is essentially what happened to Qualcomm in 2001. Scenario 2 is about 30% probability, is the parabolic reversal. This is the Cisco-style outcome. AI spending continues rising into late 2026, but the moment growth slows, even slightly, the correction accelerates. In this case, NVIDIA could retrace 60% to 70% from its peak. Scenario 3, roughly 25% probability, is continued dominance. NVIDIA manages to maintain its lead for another multi-year cycle. Blackwell architecture adoption exceeds expectations, and competitors fail to capture share. In this scenario, NVIDIA could hold its valuation longer than skeptics expect, similar to how Apple avoided collapse despite early fears of overvaluation. The real question is not whether NVIDIA is a great company. It is. The question is whether its current valuation assumes a future that even a great company cannot deliver. History tells us that technology cycles always overestimate near-term adoption and underestimate long-term transformation. The Internet didn't fail in 2000. It simply grew slower than investors priced in. AI is likely following the same pattern. The technology will change the world. That doesn't mean every company at the center of it will maintain a trillion-dollar premium indefinitely. Over the next few months, I'm watching 3 dates closely. NVIDIA's next earnings release, where we'll see whether growth is accelerating or stabilizing. Hyperscalers' 2026 CapEx guidance, which will determine the size of the next AI wave. And supply chain disclosures from TSMC and Samsung, which will tell us if oversupply concerns are real or overstated. If even 2 of these signals flip, the market may begin pricing NVIDIA very differently. And if all 3 align, the comparison to Cisco may shift from theory to warning. The moment I see confirmation, I'll release an emergency update. Make sure notifications are turned on so you don't miss it. Tell me in the comments which signal you think breaks first, and I'll share what the historical data suggests happens next. I read every comment, and I'll respond to the most thoughtful ones within 24 hours.